Hey everyone, welcome to The Explainer. Today, I'm putting on my lead equity analyst hat, and we're going to put Commvault systems through the ultimate financial stress test. Our goal here is singular. We want to strip away all the market noise and uncover the stock's true intrinsic value. To do that, we're going to build out a rigorous stock valuation using absolute, relative, and asset-based models. Let's get right to it. We're anchoring today's analysis right on Commvault's last close price of $102.78. Now, the market has priced it here, but as any focused student of finance knows, price is what you pay and value is what you get. So the big question we absolutely must answer today is this. Is this tech stock truly undervalued at $102, or are we staring at a value trap? Here is the roadmap for our analysis. We're breaking this down into 5 steps. First, establishing the baseline. Second, running the absolute valuation. Third, checking the relative valuation. Fourth, looking at the asset-based valuation, and finally, delivering the final verdict. All right, let's dive into Section 1, the baseline. Okay, so Commvault is a mid-cap software player with a $4.5 billion market capitalization. But here is where it gets really interesting. The stock is actually down about 18% year-to-date. But when you look under the hood at their fundamental cash engine, there is a massive contradiction. Despite that negative return, Commvault is generating over $1.1 billion in trailing 12-month revenue and a very healthy $181.4 million in trailing free cash flow. Look, when the price drops but the cash flow remains this strong, analysts start paying very, very close attention. Moving right along to Section 2, Test 1, Absolute Valuation. Now, a proper discounted cash flow, or DCF model, requires some explicit forward assumptions. We're taking our $181.4 million baseline and projecting it forward. Because the filings don't give us explicit future forecasts, we're plugging in highly sensible standard software industry defaults here. That means an 8 to 10% discount rate, or weighted average cost of capital to account for the risk of those cash flows, and a conservative 2 to 3% terminal growth rate for the long tail. Then we simply discount those projected free cash flows back to present value. And wow, this brilliantly illustrates the tension in the math. If we calculate the DCF based on that strong free cash flow, it yields a highly attractive intrinsic value of $133.93 per share. But if we base the DCF on earnings per share, so net income, the fair value just plummets to $59.82. So why the massive gap? Well, in the software world, heavy non-cash charges like amortization and stock-based compensation can really drag down EPS, but the actual cash hitting the bank account, the free cash flow, remains super robust. And as an analyst, I weigh cash flow far more heavily than accounting earnings. Normally, our next absolute model would be the dividend discount model to find the present value of expected future payouts. But Commvault pays absolutely zero dividends. Their trailing compound annual growth rate is exactly 0. So the crucial point here is that we literally have to throw the traditional dividend discount model right out the window. It's entirely inapplicable to a growth-oriented tech stock like this. Because the dividend model is broken for this stock, and our DCF results are heavily split between cash and earnings, analysts will often turn to the residual income model. This model takes the current book value of equity and adds the present value of future residual income, which is just net income minus an expected equity return charge. It basically grounds the valuation in the company's actual balance sheet and its ability to generate excess returns. While our primary source data lacks the specific estimates to calculate a highly reliable output here, it serves as a fantastic conceptual bridge to our next test, seeing exactly how the market values these returns. So let's keep the momentum going with Section 3, Test 2, Relative Valuation. Now, while the filings don't explicitly list a direct peer group, assuming standard software as a service competitors allows us to benchmark these multiples. What is really interesting here is how Commvault compares to its own trailing averages. The current price-to-earnings ratio looks quite pricey at nearly 53, but when you look ahead, the forward PE drops aggressively to a highly attractive 19.34. This implies some massive expected earnings growth. Also, take a look at the price to sales at 3.93 and EV to EBITDA at 39.56. Both are noticeably lower than their own trailing averages. Let's actually quantify that discount, because this is fascinating. Across the board, this stock is currently trading significantly below its own recent historical norms. Enterprise value to EBITDA is currently discounted by 16.8% compared to its trailing average. Price to sales? That is trading at a massive 29% discount. Even the EV to sales ratio is sitting at a 14.6% discount. The relative valuation model sends a crystal clear signal here. Compared to how the market historically values this company's operating metrics, this stock is decidedly on sale right now. Moving right along to Section 4, Test 3, Asset-Based Valuation. If we just look at the raw numbers, the financial reality might actually seem a bit alarming at first glance. Commvault has a debt-to-equity ratio of 4.06, meaning their debt outstrips equity 4 to 1. With an EV to assets ratio of 2.14, a pure net asset value calculation looks incredibly fragile and honestly almost frightening. But we have to remember the industry we're analyzing here. Commvault's intrinsic value lies in its software code, its customer relationships, and its intangible intellectual property. It is not tied up in physical factories or heavy machinery. Adjusting a software balance sheet to fair market value is notoriously complex because those intangible assets are what drive the revenue, completely bypassing physical asset constraints. And here is the absolute proof. Despite that scary debt-to-equity ratio, their return on equity sits at a staggering 40.14%. This brilliantly illustrates that they absolutely do not need heavy physical assets to generate massive returns for their shareholders. Therefore, as an analyst, I have to conclude that the asset-based valuation is the absolute weakest link in this gauntlet and really needs to be heavily discounted in our final synthesis.
And that brings us to Section 5, the final verdict.
All right, here is our final analyst scorecard. Our anchor market price is $102.78. Now, the absolute DCF model based on earnings definitely flashes a warning sign down at $59, and the asset-based NAV model is largely not applicable due to that SaaS business model we talked about. However, the deeply discounted relative multiples across EV to EBITDA and price to sales, combined with the incredibly robust free cash flow DCF model at $133.93, well, they strongly suggest the stock is fundamentally undervalued. The cash engine is just simply too strong to ignore. Because we consider the free cash flow to be our most trustworthy metric, which, by the way, is supported by a highly resilient free cash flow yield of 4.02%, the data points to a really substantial margin of safety. Specifically, we're looking at a 23.26% margin of safety between the current price and its true intrinsic cash-generating value. So the math speaks for itself. We've completely stripped away the noise of a rough year-to-date market return to find a cash-printing software engine that's trading at a historic discount. Which leaves us with one final provocative thought to ponder. Armed with the data that its intrinsic cash flow value is closer to $134, does this represent a genuine opportunity to buy the dip, or is the market seeing a risk that our models somehow missed?